Hey team, welcome to episode 120 of Transition Talk, where we talk about dental transitions and how to navigate the sometimes messy path to practice ownership. Well, debt is certainly a heavy load to carry, and it's likely a topic that you'd prefer to put down and ignore. And if that's the case, you may not want to think about taking on more debt as you consider ownership. But in the case of purchasing a practice, lending and that debt is oftentimes much needed, recommended, and in the long run, the best bet. We do already have a couple of episodes about lending, including early episode 5 and 50. But to provide you an in-depth perspective on the topic, we have two special guests in the studio today. Allow me to introduce Johnette Green, the Senior Regional Director of Practice Finance at Provide, and Adam Schenck, a Regional Business Development Officer at Bank of America. Collectively, they have 27 years of experience in dental practice acquisitions and banking. And while in some worlds they may oftentimes be competing for clients, they truly want what's best for them and what brings them closer to their goals, which is why we love working with them. Welcome to Transition Talk.
Thank you so much. Wonderful to be here.
Yeah, absolutely. And Adam?
Thank you, Christy. Happy to be here.
Yeah, so happy. We have a long history together and lots of clients. If you are a previous client of NDP or have talked to us about ownership, you know one of the first questions we ask you is, what's your liquidity? Have you talked to lenders? And so these two, oftentimes, if you're early in your career and you're just, thinking about ownership, I will say, hey, have you thought about lending? And if your answer is no, these two individuals are who I recommend people talk to. Clearly, I think their programs, which we're not going to focus on today, but their programs are great. But more so than that, you guys focus on education and really preparing young buyers and others, but buyers for ownership, which is really, really important to us here at NDP. So always appreciate your contributions to the wider industry and helping people just be educated about what this means to own. So I want to start off by really just kind of asking you some questions. Like, these are questions we get, and feel free to chime in and interrupt each other. Joellen will take care of that later. But jumping straight into the current news and kind of the current environment, I think that, at least I know my uneducated kind of viewpoint sometimes in other industries, when you hear, hey, the Fed is dropping rates or there's going to be cuts in the future, how long of a lag time, or kind of how does that impact in your kind of wider experience, not necessarily like any current clients, but what does that look like? And I'm going to let you take it first, but is there a lag time? Is it immediate? How does that impact someone who's might be looking to own in the near future?
Yeah, great question. I think a lot of that is already priced in. If you look at just the past few years here and what the Fed recently did, cutting rates have moved a lot between 2020 when they had that last cut to last month in September. So you're better off looking at other tools. The Federal Reserve, you can see their yield curves, their rates on a regular basis. You can see it daily, monthly. It'll give you a much better, much more accurate picture of where rates are heading and what they've been doing, because there's a lot more volatility than what you see in the news.
So if I'm hearing you correctly, if you're looking at something that's going to close 6 or 7 months from now, banks in general are looking ahead and trying to say, okay, here's what rates are going to do. You're already looking at that and looking ahead when you're kind of looking at what you're doing today, because you're really looking at when it's going to close and kind of what the impact's going to be. Clearly, no one's fortune teller, so we're just trying to do our best here.
Yeah, I would say that what you hear on the news is really talking about when Fed is cutting rate is about prime rate. And the type of loans that dentists need is more long-term lending, so more mortgage lending, and that's based on the Treasury. So if you see, actually, Treasury has been going up. The 5 and 10 year have gone up historically over the past, 6 months. So, and especially today, even, there's been a lot of talk about it increasing. But you're still going to see that the rates are low historically. So it's really still a good time to consider ownership. But, you should see that, I think, in the new year to come and after the election, I think it's going to level off. So I think it's still a good time to consider purchasing and using these type of vehicles for lending.
Yeah, I always say that when I came to NDP, I think rates were super, super low, and then they've gone up recently. But still, in comparison to other types of lending, other types of rates out there, there's clearly, still a good choice of how you're going to spend your money from purchasing a practice perspective. So, okay, Johnette, I'll let you start here. How do banks look at student loan debt? Because that's a big question. We assume all debt is bad debt, and we get a lot of people who say, I can't afford to buy a practice because I have X amount of student loan debt. How do banks typically look at student loan debt in this industry?
Well, Adam and I both, we just focus on on practice financing. So we just work with doctors. And we understand in this climate, in this profession, typically have higher student loan debt than other professions. So we're used to seeing it. So in their balance sheet, the personal financial statement, there's more liabilities there, more debt. That's okay with us because we understand as a new business owner, we're going to look at all of your expenses, but the income from the practice as well in order to pay it. So what I'd recommend is, when you're looking at the student debt, it's okay that you have it. Don't be too worried about that when you're wanting to be a practice owner.
Adam, anything else on student loan?
Yeah, I think the most important piece of it comes down to monthly payment amount, right? So it's not necessarily the total loan balance that can be intimidating to a lender, but I think the monthly payment. So different pay-as-you-earn, the income-driven repayment programs work very well a lot of the times because it's kind of a sliding scale of what you're paying, and that monthly obligation is probably the most important piece to it.
And that kind of goes against what some people think. Some people think, hey, I don't want to pay interest over a long period of time. And so if I can get that balance down, then banks will look at this more favorably. But really, it's what is your monthly ability to make a practice finance loan or to pay your monthly mortgage or your car payments? It's all of that monthly cash flow that you guys are looking at in relationship to the income that will come from the practice opportunity.
That's exactly right.
I completely agree with Adam. I mean, it's really about what your monthly payment is. So a lot of times you'll be tempted to refinance at a lower interest rate, but that's not really where it's at. It's what is your monthly payment and let's keep that as low as possible.
And this kind of leads into my next question, Adam. So when we talk about, a doctor's personal finances, I always joke that doctors graduate and they want to do everything at one time. They want to buy the house and they have the babies and they get married and they do all the things. What do you guys look at when you look at their personal finances when it comes to approving for a loan?
Yeah, we could probably spend the whole episode talking through the nuances of this question, but to just break it down as simple as possible, their liquidity is going to be a big factor. If they've shown the ability to save and what that looks like, their debt load, but circling back to that previous point, it's more about the monthly obligation associated with that debt load. And then on a case-by-case basis, depending on the practice they're looking to buy, their production is a piece that plays heavily into that.
Like, can they do the work?
Can they do the work? That's right.
Yep.
Oh,
Go ahead.
sorry. Great
no,
point.
Go ahead.
The production is important, but we do look at credit score as well. So we want to see that they're more conservative in nature, which is typically our doctors have that quality about them anyway, but also that they don't have really high expenses. So if you keep your expenses low, you really prepare yourself for ownership, you really show your production and how you're going to be able to maintain that in the new practice that you may own, all of those things play a part. It talks about a little to, your character and just the quality of your personality.
Yeah. And I think some people forget is if you are married and you have a spousal income, most banks are going to try to look at it without your spousal income and just kind of look at your production or the practice cash flows. There are times when you will look at the wider family cash flows, but clearly, some people want to avoid that. They don't want their spouse to have to be listed on this new business loan they're getting. They just want to be by themselves. So thinking about that and kind of how your monthly expenses look just with your cash flows, I think is an important consideration too.
It's a great point.
So I'm sure you guys have lots of stories. We like stories with no names, but what is an area that you see buyers mess up the most? And or what are they not prepared for when they come into this kind of okay, I'm looking to buy a practice. I need to get lending. You guys kind of sometimes will work with them before they even work with us or someone like us. So give me kind of a area of caution or something that they're not prepared for. Adam, I'll let you start.
Yeah, I think the piece that a lot of buyers kind of ignore is when you're buying a practice, what you're really buying is the goodwill. And the relationship that you have with the seller throughout the transition is important. And if you think that you're overpaying $5,000, $10,000, $15,000 for that practice, to negotiate to feel like you won in that deal, that negotiation, what's that going to do to the goodwill, right? And, it's easy for me to say it's not my money, just pay the full price. But I see a lot of people negotiate themselves to a point where it impacts the goodwill.
I think that's a great point. What about you, Johnette?
I would say that I've had not too long ago a doctor come to me and say, I am in such great shape. I paid off all my debt. I don't have anything left. And I also used all my liquidity to do it. So it was so unfortunate.
They did not listen to the podcast.
That's right. That's right. So I said, I love that you don't have any debt anymore, but now we don't have any liquidity. So we're not meeting some of the metrics that we're looking for. We want to see that you have money in the bank. We don't want you to spend it. Adam and I want to loan you the loan so that you don't have to bring money to the table. But we love seeing that you have that quality that you're able to save. And also, I'd add production. I've had someone come to me and say, guess what? I started working part-time because I want to focus on buying a practice. Well, we really need to prove your production. I'm seeing that people are wanting sometimes to buy a big practice. Well, we've got to show that you can
Do it.
maintain that production in the practice so we can rely on the income also. So I think what Adam mentioned and those things will put you in a good position.
Yeah, and I think that's, doing your homework, getting educated 1-2 years before. I always say, hey, having the conversation and understanding what you're going to need to have so you have time to work and get there. Because I think ownership is something that someone says, oh, that's, a couple years down the road, 3 years down the road, 5 years, when I graduate, and they work a couple years and they're like, okay, I'm ready. And they just haven't put that thought into it. So leads me to my question. How early do you want to talk to someone? Part one. And how early can someone typically actually go through the process with you in order to get lending if they're thinking about buying? So twofold. Johnette, why don't you start this one?
I'd say it's never too early. I mean, Adam and I both are talking to doctors even when they're in residency or they're still in school. I find that doctors really are getting a head start compared to like 5 years ago.
Yeah.
But I think it's never too early. It's really about what practice you're going to purchase.
Yeah.
Because we get them prepared, make sure that they're in good position to qualify for lending. We need a target. We need a practice to look at so we can look at those revenues and financials. And ultimately, how much are you going to make as the new owner in order to service the debt and pay it back?
Yeah.
Yeah, Johnette really hit the nail on the head there. It's never too early. You never want to see somebody in a situation where they found their dream practice, their dream opportunity, and now is the first time they're picking up the phone to have the conversation, only to find out that they haven't prepared themselves financially to get that loan. So I think whether you're in school, in residency, or just got licensed, it's certainly never too early.
And I think, too, one of the things I hear, we'll have conversations and we'll say, hey, have you talked with the lender? And they're like, yep, I've been pre-approved. And I'm like, oh, okay, great. And then I'll say, okay, have they looked at the financials of the practice you're looking to buy? And they're like, oh, no, I haven't sent them that yet. I'm like, well, you might personally be okay to get a loan, but they haven't looked at the opportunity, right? And I think that's something unique in this industry. If I want to go out and buy a home, I can go get pre-approved for a mortgage up to a certain level because they're looking at my income streams. But this practice is going to be your income stream. So that practice, if it has a really horrible overhead and no cash flow, like even if they are personally set, it might be really challenging to give them a loan for that practice. And I think that's something that some buyers don't understand. So having those conversations, getting yourself personally ready, and then understanding that the practice income and the cash flow is going to be a big driver of that process.
I've seen a lot of those stories where people have been qualified for a large amount and they want to buy a smaller, underperforming practice, and it's just not profitable enough to support their debt load. They have an expensive house, expensive car. So it's very common that takes place.
Yeah, I hate that when that happens. Okay, let's kind of flip the table a little bit. We talk to a lot of sellers who are current owners who are looking to bring an associate into their practice. They're looking for maybe just a 100% purchase, kind of more of a walk away. And their kind of mentality is, we hear a lot of people say, hey, I'm not interested in doing seller finance, or I may have to do a staggered sale, or I want to do it this way because I know that it's really hard for buyers to get financing. And it's really hard with their student loans for them to get financing. I think you guys have covered a little bit of that, but what do they need to be aware of when they are looking to find a buyer, find an associate? Is it hard to get lending for buyers these days? I mean, this is something that some people listening to this podcast might have not thought about and are now looking to kind of find a buyer. And what does the lending landscape look like for buyers of practices that sellers need to be aware of? Adam, I'll start with you.
As far as the landscape goes, there's a lot of buyers out there. I would consider it overall a seller's market, but I think the geographic region you're in will impact that. If you're in a more rural area, it might be harder to find the buyer. If your questions along the lines of what do sellers need to be aware of, keep your options open, right? If your practice is big enough to justify an associate, that's going to be your prime choice, right? So think about that. Think about the long term when you're hiring that associate. Is this somebody you can see yourself partnering with and growing with in the future?
Let's say they find that person and they're in the practice. What do they need to be aware of when it comes to that person now having to go to a lender and get a loan? How can that seller support that person, right? And kind of what do they need to do to help prepare them to make sure they can get the loan? Any ideas there, Johnette?
Yeah, I always encourage the buyers, because Adam and I are usually talking to buyers.
Yeah.
But I encourage them to, really engage with the seller on a personal level, get to know them, be transparent about what they're looking for. I think that really resonates with the seller because it's about the patients, the employees, the whole business as a whole. And we want it to be a good fit. I think that the more transparent and open that the seller is about who they're looking for, what's important to them, what their legacy is about, I think it's about relationship. It's somewhat of a matchmaking.
No, 100%.
We want the numbers to work as well.
Yeah.
But a good fit is good for the buyer. It's good for the seller. It's definitely good for the banks.
Yeah. And if I'm putting together something you both said since we've been talking here, the production of that associate or soon to be partner is going to be really critical, right? So if you're a seller listening to this, hear that and know my job, right? If I want this person to be able to get a loan and kind of buy into my practice and create this partnership or buy my practice as a whole and they're in my practice, my job is to keep them busy and make sure they can show they can do the production. It's not a situation where I just keep doing all of it and hope you get the money, right? Like the associate has to prove they can kind of pull their weight. And you guys are going to look at that.
It's absolutely true.
Yeah, production is one of the most important components because we want to make sure that we can rely on the income of the practice. They're going to be able to perform at whatever percentage level, either maybe even 100% of that performance. So we want to be able to rely on the income to pay all the debt, personal and the new payment for the loan.
If a seller's listening and they're having associates going to create a partnership, what is the seller's involvement in that loan? Is it like a guarantee? Do they have to be involved? Like, how do you guys view sellers in relationship to the buyer in a partnership's debt?
Yeah, they're not personally going to be there on the loan, that is, but the practice will be. So it's important for sellers to be aware that at the finish line, they'll have to sign on behalf of that partnership or that practice entity, but personally, they shouldn't be tied into it.
And can one of you explain, if you're buying a practice or you're selling a practice, you'll hear lien on the assets. Can one of you explain just in like very layman's terms what that means and like why a bank of any kind would want a lien on what they're buying?
So we typically have a lien on the practice, on the assets of the practice. Different when you buy a house. Well, you have an asset there. You have a piece of real estate. But if you have a loan, it technically still belongs to the bank.
Yeah.
Right. On these practices, it's all about goodwill, as Adam mentioned earlier. So as far as, the equipment, the furniture, most of the value is in the goodwill of the practice. So we'll have a lien on it. If you
What
want,
does lien mean?
it means that the bank still has collateral on the assets, including the goodwill. So if the buyer or the seller goes to sell it, it needs to be free and clear.
So it's like a claim, right? Like the bank basically says, I have first dibs. on these assets. And no other bank, right? Like if you had a lien on my practice, but I wanted to go, buy another piece of equipment. So I went to Adam. Adam's going to be like, well, I can't give you a loan because Johnette still has that lien and I have to have the first lien because I want that first right. Is that
correct?
Right explanation, I guess?
I always explain it, the practice when we're buying goodwill, if you took a practice and turned it upside down, everything that fell out, well, that's what we could sell.
Yeah.
The chairs, the hand pieces. Well, that doesn't turn out to be much money in the end. So not in comparison to the value of the goodwill. So we'll have an all asset lien on the practice so that if something happens to the loan, then we've got some of our collateral in place.
Some recoupment ability.
That's right.
But clearly none of us want that to happen. Right?
Absolutely not.
Well, the industry has such a low default rate. So as long as you have great advisors next to you, you're doing the right things, you shouldn't be in that category. It's very low.
Yeah. And I think we hear a lot of sellers who will say, I don't want to lean on the assets of the business. And that's a really hard hurdle for a buyer to overcome, right? Because at the end of the day, like you are selling, like you said, a lot of reputation and your services and kind of the goodwill. And so going to a third party bank is going to be very challenging. I'm not aware of a bank that will do that without a lien. So if you're a seller listening, understanding that you personally, in most situations, clearly we're not talking in, definitive. In most situations, the seller's not going to, you as an individual or not, right? But your partnership in this practice, right? Which again, if you're having someone buy in and you're trusting them to be your partner, you kind of are already guaranteeing, the practice is already guaranteeing the loan. And you're both kind of have some skin in the game to help make that successful. Okay, let's talk about working capital. This is a concept that I feel like I have to kind of explain or tell people that they need. Adam, working capital, what is it and what is it used for?
Yeah, so working capital is funds that you receive at closing with the purpose of using it to operate the practice. When you take over a practice, you're going to have fixed expenses, you're going to have rent to pay, payroll, and you might not have money coming in that first day. Right? The patients you see day one, especially in an insurance-driven practice, you might not see that income for 30 or 60 days. So working capital is designed to bridge the gap from when you take over to when your collections have hit full stride.
And then how much is it typically at the same terms as your overall practice loan? Is it different terms? Just generally, not clearly anything in particular, but is it generally, should it be expected to be at a same rate, at like a credit card rate? Like what's the kind of difference in the terms of working capital in relationship to a larger practice loan?
Yeah, it's generally included in the same loan.
Okay.
There are other options. You could take like a line of credit or something like that instead, but that's going to be closer to that credit
More
card.
the credit
right?
card rate.
Yeah.
How much, Johnette, if we talk about how much working capital, I'm sure it varies by person and by practice, but is there a general rule of like if I'm getting $1 million loan for a practice, I should get X amount of working capital, like a rule of thumb?
We like to see at least 2 to 3 months of working capital for overhead expenses. So rent, payroll, supplies, things that you're going to pay, marketing expenses, especially when you first become owner, so that you'll have enough money in the bank to pay all the bills while your new production income is coming in.
Is it used to pay like transaction expenses and like personal expenses, or is it really just expenses of the practice itself?
Well, essentially, it's going to pay your personal expenses because you're the new owner.
Yeah, I guess
It's going
that's
to pay
true.
your bills,
Yeah.
right? But it is intended for the practice. That's where having some liquidity of your own comes
Yeah.
into play and be really helpful to pay your own expenses. But you should have enough to pay yourself, pay all the practice expenses, the employees, and, be ahead of the game.
Yeah.
So 2 to 3 months, I think, is a good
In 2 to
benchmark.
3 months, those are more of like the fixed expenses, the things you have to do, right? Like we always say, hey, you should be able to pay the staff. You should be able to get supplies and be able to kind of service those patients over the course of time. And that's hard, right? Because if you look at it, it's not always going to be even, right? If you're doing an analysis, it's rare that you're looking at things on a month by month basis. You're looking at a 12-month P&L and saying, hey, this is what they spent over the last 12 months. And you're saying, what is 3 months average? But there's going to be months that are higher and months that are lower. And so sometimes we'll see, I'm sure you guys see this too, buyers will be like, I don't need working capital. I'll just, use my own. And I always say, hey, like get the money, right? Like let's get it. And if you don't use it, great. Keep it in an account. You can pay it off down the road, but better to have too much than too little in those early months of ownership.
Agreed.
That's why I see some of those clients that opt for the line of credit instead of the working capital just so they have access to it. Ultimately, if you use it, it's like a credit card, right? It's going to be a higher rate, so it's not as attractive. So working capital is typically the best bet in taking as much as you can.
You guys look at a lot of practices, so this isn't necessarily like a lending question, but are you seeing practices? I feel like we're far enough past COVID where we're finally like not talking about it all the time. Are you guys seeing practices kind of come back, or are you still seeing some that have kind of continued to go down since COVID, or are we kind of leveled out and those that will succeed have and those that won't?
Well, I think even through COVID, dental practices, fared very well. People were still coming in after they were opened back up. And I think it trickled into the next 2 years. I mean, in the market, I'm still seeing practices that are doing well. They may have leveled off some, but they're still performing usually a little bit better than they were before COVID.
Adam, I'll let you take this one. Are you seeing a different mix of like more mergers or more partnerships or more buy-ins or more walkaways, or is it still pretty consistent over the course of the last 5 years or so?
I think it's still consistent. I think the conversations I'm having have changed. A lot more people asking about DSOs, how to become one, a lot more clients with those kind of long-term ambitious plans. So some of the conversations have changed, but overall, the practices have not.
I agree. I'd say, 5 years ago or longer, you really had only plans for one practice. Now, when I'm talking to doctors that want to become owners, they're really more entrepreneurial. They're saying, maybe I want a bigger practice now, a larger practice, or maybe someday I want to have multiple locations. Maybe I don't want to be chairside in my entire career. More of a managerial level. So I think that it goes in line with having podcasts like this one, being more educated, having the right advisors next to you, that you can really see, hey, I want to take a longer look at my career, not just the first few years, but with the end in mind in the beginning.
Yeah. Okay, I have 2 more questions. My last question is going to be like your tidbit of advice. Okay, so think about that. I warned you. You're welcome. My other question I'll ask, and I'll kind of want each of your input. You guys work with a lot of buyers, and a lot of buyers that we speak to say, hey, they've heard that they need to own the real estate. They need to own the real estate at the same time as the practice, and they want to do both at the same time. I know my experience, but how many of your buyers buy both at the same time, or is it we buy the practice and we come back and talk about the real estate down the road? Johnette, I'll let you start.
I see it more and more that doctors want to buy real estate at the same time. Depends on how prepared they are. Have they saved? Have they put themselves in the best financial position in order to do it? And if it's available. I always say that when you're talking to the seller, if they're willing to sell it, absolutely, let's look at it sooner than later. But the practice is really what they're going for and what you need to focus on. As long as you have first right of refusal or it's down the road for you at some point, I think it's a great situation to be in. But a lot of times we find that they can afford the real estate right away and the seller's willing to sell. So we have those two things, then absolutely, they're taking the opportunities.
What's your experience?
Yeah, I think products have changed over the years, and qualifying for 100% financing on real estate is a product that lenders have now. So the ease in which somebody can qualify to buy a property has kind of lowered that barrier and increased the number of conversations we're having as a result. So yeah, to Johnette's point, when that opportunity is there, let's have the conversation. But I think the practice is priority number one. You shouldn't ignore priority number two.
Yeah, and I think some people get nervous because the seller owns the building. What if they don't allow me to stay here? I think it's important for everyone listening to understand that like having a long-term lease in place, if you're not going to purchase the building, is a requirement of pretty much any lender we've ever worked with, because you guys want them to make sure they have a space to operate that practice in,
Absolutely.
right? You guys understand if you have to move the practice, it's not guaranteed the patients are coming with you if it's too far away.
And it's expensive.
Yeah, exactly. And so, I think that long-term lease and kind of making sure that if you don't have the option of purchasing the building, having that long-term lease helps mitigate some of that risk. And like you said, Johnette, having right of first refusal and, maybe option periods at some point in the future clearly can give you that benefit. And later, the practice cash flows also go into your decision on, hey, can you buy this real estate? You guys see that as a package deal, given that's where the practice operates.
Yeah, even if the building isn't for sale, it's a lease. It's always going to be a lease. We're looking at the income from the practice.
Yeah.
And that's not going to change if you own the real estate or not.
Yeah, absolutely. Okay. This has been super informative and fun. Adam, if we have to leave and give people one tidbit of advice from a lending perspective as they look into ownership, what's your final takeaway?
Yeah, my one tip would be to just make sure you're working with industry-specific people. Make sure, your lender, your accountant, your buyer's rep, whoever it is that you're surrounding yourself, when you build your team, make sure that they're dental specific. I've seen far too many clients get burned by somebody who wasn't well-versed in the field. This industry is so unique and so amazing. It's important that you surround yourself with individuals and advisors who understand what you're doing.
So good. I meant to say that.
I wanted to say that. I would add that really know what you're looking for and what's important to you, what kind of practice that you want to work in, what kind of dentistry you want to do, and really what kind of business owner do you want to be. Well, when you're talking to lenders, they'll be asking these kind of questions like, what have you thought through? And have you put a plan together? So I think that really helps you be more focused and decide, not looking at hundreds of different practices, but really have more of a focused approach and understanding, are you pre-qualified and have you done all that you could?
Man, I couldn't have planned it better. I mean, it's like the why and like the dental specific experts. This has been so fun. Johnette, thank you.
Thank you so
Adam,
much.
thank you.
Thanks for having us.
All right, team, that's all we have for today. Remember, if you have the desire to, in the future, purchase a practice, then you need to be educated about your personal financial situation. You need to be educated about what this lending environment looks like, because like Adam said, it is incredibly unique. It's not your local bank, small business lender who you need to be talking to. You need to be talking to an expert in the field. And as you know, we're always happy to connect you to these folks. They're a wealth of knowledge. And so if you have that desire and haven't asked, reach out and we're happy to connect you. Thanks for joining us on episode 120 of Transition Talk. As always, make sure to share the transition love with those who may not know of us yet. And of course, subscribe wherever you listen to your podcast. Until next time.